You are listening to Mining Stock Education.
The sentiment right now, it's not amazing in the market. From a junior point of view, there is money being raised, despite a lot of juniors complaining that there's not enough money. I would argue there is plenty of money for good projects, and I would say the less good, let's call them, without being too rude, juniors are not finding money, and perversely, when every junior is raising money, as much money as they want, you probably have a problem, because I view that as peak capital misallocation.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me, I have Neil Adshead, consultant analyst and fund manager. In our conversation today, you're going to hear Neil's views on recent news out of Malay, construction financing ratios, risk management, the project generation business model, and where he sees the most opportunity in the resource sector right now. Neil, it's a pleasure to have you. Thanks for coming on the show.
Thanks, Brian. I appreciate the invitation and nice to meet you.
I think it's best, you're new to the show, if we could start the conversation off with an overview of your career, where you were and where you are today.
Yeah, just a quick summary. I've got a geology education. I did a first degree in the UK. I worked on the oil rigs in the North Sea for a year, and then moved to Australia in 91, and graduated with a Ph.D. in Economic Geology in 1995 from James Cook University in North Queensland. I then worked for a major mining company called Placer Dome, which is one of Canada's biggest companies at the time. Spent 10 years with Placer Dome working on a mine in Papua New Guinea and in the corporate office in Vancouver. That's why I ended up in Vancouver. I've now been in Vancouver almost 25 years. Left Placer Dome in 2004, joined a hedge fund in San Francisco, basically doing analysis of Vancouver juniors for that hedge fund all through the bull market in the lead up to the GFC, which was a great time to be a buy-side analyst. And I basically stayed with that group until 2011, and then I joined Rick Rule at Sprott. Worked at Sprott on and off for 10 years, and I left Sprott early 2023. I was a fund manager for 4 years in my last 4 years at Sprott. And since Q2 2023, I've kind of been an independent consultant, I suppose. I now currently I have a little part-time job with Centerra Gold, investing some money into gold exploration juniors for the gold producer. I also have contract jobs with two big buy-side funds, and I'm a director of Scout Discoveries, a private explorer in Idaho, and I'm also an advisor to Inflection Resources, which has porphyry exploration initiatives in New South Wales in Australia.
Recently, the governor of Mali issued an arrest warrant for Barrick Gold CEO Mark Bristow. They've accused him of money laundering and financial regulation violations, and it looks like it's around $500 million that they're saying in unpaid taxes. As an analyst, do situations like this impact your investment decisions towards West Africa or other high-risk jurisdictions?
Well, I would say it would definitely impact my view of Mali as a place where I would want to either invest money or have money at the moment. Obviously, when the government's making somewhat outrageous statements like that, it's pretty hard to have any kind of confidence in the country as an investor. But maybe what's even bigger is that the rest of the world, all the other investors are reading those news headlines too, and probably know, I'd say, a little bit less than Mali than I do. I've been to Mali a couple of times. And, as well as yourself believing in a country, you kind of feel like most of the other population have to believe in it too. So a long answer to your question, that would certainly turn me off Mali right now. Now, some countries in West Africa are currently, excellent investment jurisdictions, like Côte d'Ivoire is fantastic at the moment. So you can't really blanket the whole of West Africa just based on what's going on in a single country.
Right. Guys like Rick Rule will talk about jurisdictional risk, and he attaches it to the moniker of price. And I think what he essentially says is for the right, geological potential and at the right price, that maybe a place like Mali would be doable, or places like the Congo that are sort of maybe in that same ilk. Do you feel the same way?
Rick's really coming from the place there where you're supposed to buy them when they're hated.
Right.
And, if the geological quality is good enough, if it is a true tier one asset, similar to what Robert Friedland had with Ivanhoe in Congo, then, I was with Rick on that journey, for many, many yees. I would say yes. It depends on your investment time horizon too. A lot of retail investors are a little bit short term. They think short term. They don't think long term. So it comes down to geological potential, definitely. Jurisdictional risk is very important, but there certainly are places in the world where I wouldn't put a penny, because I just think the jurisdiction is far too hard. And, a little personal test for myself, a little personal metric I use is to actually look at the health of the junior mining sector within that particular jurisdiction. And I'll just throw an example out there without picking on a country like India. I mean, how many juniors do you know operating in a very prospective country like India? The answer is zero. And the reason is a junior will turn up there, look at a project, realize that it's far too hard due to government bureaucracy and all sorts of other issues like, 1 billion plus people, and they go away. So it's a good indirect metric of the health, the investment health of a jurisdiction is to look at the size and breadth of the junior mining sector there. In a way, I refer to it as like a canary in a coal mine factor.
Recently, Trillius Gold released news of multiple LOIs pertaining to debt financing from both European and Canadian sources. They didn't release the terms, though, which I thought was sort of interesting. So I've got a two-part question for you. The first is, what's your view on the proper ratios between equity, debt, and potentially a royalty or stream on the upfront Capex raises, towards the overall cost of capital?
I don't think there's a perfect ratio. I think the ratio is often dictated by the quality of the project. And this may sound a little bit weird, but if you've got a super high quality project, sometimes they can support 100% debt. And some people may think, that sounds a bit weird, but the bank's looking at it. The bank wants to get its money back. And if the bank looks at this thing and goes, hang on, we're senior secured on this asset. If the company messes up some way, but the asset's still amazing, we're going to get our money back. So they will provide as much debt as possible. So in a way, the higher the debt ratio, the higher the geological quality that the bank has determined from its due diligence. So there isn't really a definitive answer to your question there. But it's to actually get debt from banks can take months and months of painful, tortuous, expensive due diligence, and even at the end of it, they might not actually come through. Whereas the royalty guys and the streaming guys, they tend to be a bit quicker. They tend to be a bit more of a motivated hunting pack type group of people, and so that's probably why we've seen the rise of more royalties and more streaming recently, because I think it's a bit quicker to get the money, and every sort of month you delay building your mine costs you a lot of money because you get everybody sitting around there with tools and equipment, waiting to get going.
Right. There's a couple of deals that I can think of off the top of my head, and talking to the CEOs after the deals were complete, they at least tried to sell me on the fact, I don't know if this is true or not, that the lowest cost of capital was coming from the royalty companies, and this is sort of why they went that direction. Do you buy that, I guess, along with the speed?
I have seen some streaming deals where the IRR quoted is very, very low. So you could say yes, superficially, but the problem with a stream or a royalty is that, they are for life. So if you got a 5-year, 10-year mine life, and you think, okay, the stream's only this on a 10-year mine life, but then you make the mine life 50 years, the stream never goes away. And, in year 40, that stream's going to look pretty expensive. Whereas if you had debt and you paid the debt off and it's gone, all the profit goes to the shareholders. So you'll quite often hear companies, issuers will say, oh, this is dilution-free financing. Like, no, it's not. Yes, it's basically not diluting your equity today, but it's diluting your cash flow for the rest of your life.
The second part to the question, and this does not necessarily have to be connected to Trillius, but I thought it was really interesting that these governments have taken an interest, and I suppose in other ways they almost need to, given some of the other decisions that have been made. But governments are saying, hey, we're going to put money into these critical mineral projects. And so the question I have is, from an investor or a citizen's point of view, is whether this makes sense or whether they should.
There's different aspects to that question. I think from a geopolitical, strategic point of view, a country like the United States probably wants to have security supply in a kind of like global war scenario. So there's an element of me says yes, that the US government, and I'm talking specifically about the US here, as the big kind of superpower, probably should be doing stuff like that. But personally, as a bit of a capitalist, if the project's good enough, then there's just billions and trillions of dollars of capital in the world. They will find that investment opportunity, and if it's going to generate a decent return and it should be built, then it will be built. I don't necessarily like a Soviet-style system whereby the government's dictating where taxpayers' money is going into which projects, because that introduces all sorts of corruption. And also, the people who work at the government, I wouldn't say are probably the best mining analysts in the world.
Very true. As a fund manager focused on the resource sector, you're tasked with managing a huge amount of risk. It would appear in bear markets that this is almost compounded, given the risk of redemptions, at least for the open-ended funds. If you agree with that statement, does a fund manager take the risk of the redemptions in any way in how he deploys money during market cycles like that?
Yeah. One thing that I probably didn't even really think of, liquidity and redemptions when I was a mining analyst, because I wasn't really exposed to it every day. But as a fund manager, that is huge. It's absolutely enormous. It will often stop you buying too many illiquid juniors, because one day you'll wake up and you look at your book and you'll go, okay. If I hit a bear market tomorrow, how much of this stock can I sell sensibly, within, let's say, 20 working days, 20 business days? And you'll have a bit of you'll basically scare yourself, because you'll go, hang on, I'm kind of stuck here. So when you realize that in the future, going forward from that point, you're always trying to manage your liquidity. You always want to be able to, as my old fund manager used to say, you want to be able to fight another day. You don't want to get dragged down with the ship. And there will be bear markets, there will be bull markets, and it's very, very. So as well as trying to pick good stocks, you're also looking at the market liquidity, the market sentiment, and trying to factor that into your decision making, because you really don't want to smash into the iceberg one day, which I've seen several fund managers do, purely because they could not get out when they wanted to or had to, even based on their redemption features.
Right. So I mentioned closed or open and closed funds. Would you be able to give, I believe some of the viewers may not know what that means, the difference between the two. Could you give us a quick definition on open versus closed?
Well, an open fund means it can just sort of keep growing. Money can come in and money goes out with probably quite a non-restrictive or unrestricted redemption feature. But whereas a closed-end fund often just has, you have 3 months. So, for example, Rick Rule used to do, long-term closed-end funds. He would have 99 investors, which was the maximum he could have. He'd raise, just making numbers up here, say $10 million. But he would then lock those investors away for 10 years. So it was essentially a closed-end fund. So somebody couldn't come along in year 2 and say, oh, it's, excuse me, Rick, can I give you $1 million? Rick could say, sorry, the fund is closed. But that also applies to the people in the fund. Those people in the fund are locked in for 10 years, and they may have some sort of disaster in their life, and they call up Rick in year 2 and say, can I have my money back? And Rick's like, sorry, it's all invested in illiquid juniors that have a 6 to 8 year investment horizon. So no, sorry. That's essentially the difference. One is the money can come in and out, which is open, and the other is the money is basically locked away, which is a closed-end fund.
Relating this discussion to where we are in the current market, in your view, where are we in the cycle?
Well, it depends what you mean by the cycle. Do you mean the cycle of sort of sentiment towards junior mining stocks?
I would say so. Yeah.
Because if you think of the cycle of metals which are consumed, it's very, very cyclical, because obviously the metals get consumed, we sort of run out, the price goes up. Because the price goes up, we all run out there and find more and mine it, and the cycle goes up, the cycle goes down. The sentiment right now, it's not amazing in the market. From a junior point of view, there is money being raised, despite a lot of juniors complaining that there's not enough money. I would argue there is plenty of money for good projects. And I would say the less good, let's call them, without being too rude, juniors are not finding money. And perversely, when every junior is raising money, as much money as they want, you probably have a problem, because I view that as peak capital misallocation. There's a lot of juniors out there which shouldn't be raising money, because they're ambulance chasing, or the project is not very good, or they're kind of pump and dump guys, and I've met many of them over the years. So I quite like the current market. I think the current market's good. It's a stock pickers market. Good projects are getting financed, and bad projects and bad groups of people are not getting financed, and that's really the way it should function.
You've done this for a number of years so far, and relating back to when you first started to where you are now, what aspect of being a fund manager has changed the most over your career?
I would say more about working on the buy side, so working on the investment side. I'd say maybe two things immediately come to mind. When I first started as a buy side analyst 20 years ago now, would have been mid-30s. There was quite a lot of very, very experienced guys in their 50s, guys and girls in their 50s and 60s who'd been in the mining business for 30 or 40 years, like superstars. They knew everything about metallurgy, about jurisdictions, about mining, about exploration, especially on the sell side as well as on the buy side. So there was a lot more very experienced mining analysts. Today, when I go to some of the big investment conferences and talk to some of the people on the different buy side and sell side roles, they're quite inexperienced. They don't really have a lot of experience in the business. So I feel like the due diligence side has declined for some degree in the financial community, and I think part of that is due to, which is probably another point, is regulation. I think the regulation has slowly increased for fund managers, which obviously regulation costs money, it crimps their margins. And, when your margin's being crimped, when there's a threat of having a small bonus at the end of the year and you think you've got excess labor, who are you going to fire? You generally fire the mining analyst, unfortunately. One fund manager once made a great quote to me. He basically said, mining analysts, you don't need them in a bull market and you can't afford them in a bear market. So that's essentially what he said to me. Now, final point is just access to information. The internet was sort of not really, is pretty basic 20 years ago. And then plus we've had the rise of stuff like a smartphone. The first iPhone, I think, was only 2009. And now we've got so much information at our fingertips. It's just remarkable. So that's great. The problem is now we have a lot of, let's call them self-appointed gurus on CEO.ca who have a very, very huge following. And I think what that's doing is actually increasing the capital misallocation. Money's sloshing around between, I think a lot more people are speculating rather than investing. It's so easy now, Charles Schwab, $9.99 trade. You don't need to talk to your broker anymore. You don't need to, so it's kind of, I think there's more capital misallocation, simply because there's more information and more access to putting on trades yourself. That's kind of a long answer to your question, but yeah, there's, I could probably talk about changes in the investment community over the last 20 years. Probably talk about it all day.
Well, what's interesting, one of the things that I've seen over the last year is that a lot of my American friends, in terms of full service brokers, have been basically kicked out, or the full services that are offering stuff to clientele have huge premiums to be paid on the buy and the sell, and so a lot of that American money is left. What do you think of that? What do you like? The America seems to be, you talked about it earlier. It's probably the biggest market in terms of available cash, and it looks like the Canadian market is closing itself on it.
Yeah, similar to what I was saying before about regulation. That increased regulation for fund managers is obviously increasing the regulation too for people who provide broker services to retail clients. And because of that regulation costs money, so that money has to be passed on to the client. So it's like a bit of a death spiral, and it's kind of for that sector. And it does push people, let's say, into the internet. And then those people don't really know what to buy. They're interested in mining, they're interested in gold, they're interested in copper, uranium. They don't really know what to buy, though. They don't know how to analyze a company. So they then find some guru with offering free advice on the internet. And I find it a massive concern, but I don't know what the solution is. It's the regulators are actually supposedly protecting the retail, the little retail guy, but they're actually pushing the little retail guy into these dark recesses of the internet, and they're probably getting fleeced more than what they were before.
There's a definite divide between investors that are willing to speculate in project generation and soul exploration. But I think the soul exploration seems to be so sexy, in terms of how the story is told. But most often I hear that there's too much upside is given up by a project that is JV'd, and this is in reference to the project generating business model. What's your view on project generation?
Well, I worked with Rick for many years, and he was he's a big proponent historically of the prospect generator model. I'm not sure if he's still that much of a cheerleader for it today. There's elements of it I quite like. It is kind of outsourcing a fair amount of the equity dilution risk for shareholders, and I get that. And there has been some great successes in tightly held stories, such as Altius back in the day, Virginia Gold back in the day, but that was, those two today, their big success was, let's say, 10 to 15 years ago, which is part of the problem. I find the prospect generator model a little bit boring. It's almost like I want exposure to exploration, but I want someone else to do the exploration. I don't want the risk of my equity being diluted, and that's great. But then you're always relying on that company, your prospect generator, finding another company that's a superstar company that can raise money and will do the work. And I just find the model a little bit boring. And most people invest in juniors. A big part of it is the actual thrill of the hunt, the excitement, that thrill of gambling. And, they put money in and go, right, these guys are going to drill 6 holes into a target. It's kind of shit or bust, so to speak, excuse my language. As in, and every 1 in 100 goes to the moon and they're up 10x and everyone's super happy. Usually they miss. Well, that's just the nature of the game. But I think people seek that risk. People go to the casino. The gambling industry makes tens of billions of dollars a year, even though when you walk through that door, mathematically, over time, you're going to lose your money. But people want that. People want that thrill. They want the thrill of the hunt.
Yeah, I like, speaking personally, and I can attest to that. Like I can say that a part of me definitely feels that thrill and have put money in companies in the past, probably along those lines. And I think losing money has definitely pushed me towards prospect generation. And I think, but for me, they're not all created equal. Like I would not put my money in 5 or 6 prospect generation companies. To me, you want to be just like picking any company, very focused in on that one company. And like you said, with groups that seemingly are able to attract, big money, whether it's through the seniors or other juniors that can raise the cash. Over the last 3 or 4 years, the addition of advisors to junior mining companies' corporate decks has become a big thing. And you yourself are listed with at least one company that I know of as an advisor. Generally speaking, how should investors view the impact of an advisor to a junior mining company?
I was going to say it's complex. It's not, there's no single answer to that. Some advisors are incredibly useful because they are used by the management team. They are a source of information. Quite a lot of advisors are just added to the biography page of a company's website, given 100,000 options, mentioned in a press release, and then they're never seen of again. And it's not their fault. It's more the issuer is just using it as a marketing gimmick. So you kind of, maybe you need to talk to the company or even talk to the advisor and ask them how involved they are really in the company, or are they just there as a figurehead that's basically a marketing gimmick? Now, I kind of developed, when I was at Sprott there, I looked at so many companies, I realized that there is actually, I'll call it a bad number of advisors. And I have seen juniors, and the record I saw was 9 advisors on one company. And when you start to see, let's say, more than 3, I think it's definitely a marketing gimmick. I did see one company with 9, and it's very obvious after 20 minutes of looking at the company that this was just an ambulance chasing junior that's trying to ride some thematic wave, and they've just put all these big name people, giving them 50,000 options just so they can stick their name on the website, and that's it. So there is no firm answer to that. I think most advisors are probably not really that involved with the company. Would be my general feedback. Yeah.
Seneca says that luck is when opportunity meets preparation. In your view, how much does luck have to do with success as an investor in the junior mining sector?
Success as an investor. Okay. Unfortunately, I think if we did the maths, and I've never done it, I think unfortunately most investments in the junior mining sector don't make money, but that's just because it's a very asymmetrical proposition. For every 10 bagger, 20 bagger, most of the time you're likely to lose your money. You lose 50% of your money. It's just the nature of the game. I personally, and this I could talk about this all day too, and you can ask other people who know me about my view on luck. Luck doesn't basically exist. People use the word luck to sort of explain some, voodoo concept out there, some reason why something happened, and they can't explain it, and they say it must be luck. So I always try and turn that question around and say, well, you tell me what your definition of luck is. And we can have some philosophical debate for hours, but maybe next time I meet you in person, maybe in Vancouver for VRIC, happy to sit down over a pint or two and we can discuss that in more detail.
Sounds good. Is there a particular metal or segment of the sector right now that you're most attracted to?
Depends on time frame. Thinking maybe long term. Everything I've read and, my own experience and given what's going on in the whole sort of decarbonization, electrification of everything, it's hard not to have a warm view towards copper. Now, copper might not do anything in the next 12 months because of, trade wars and tariffs and all the other issues. But just when you look at how much copper's mined and consumed in a year, where the future supply is coming from, it is quite lumpy in different parts of the world. Not many of those, development projects are in particularly nice places. There just has to be a rise in the copper price of, let's say, from $4 to $6 over the next 5 years. Let's say some people might not think that's sexy enough, but talking specifically about investing, that seems to be the relatively easy one. Let's say by the end of the decade, I think we should be seeing copper in the $6-7 range, without too much trouble. I mean, gold as well. Gold's had a great run, but we're still seeing central banks of the world, given what's going on with certain foreign nations trying to eschew the dollar a little bit, and they're buying gold with their dollars. I just think the gold sector, the gold price outlook looks pretty bullish too.
Just a further question on markets. The Chinese, the relationship with the Chinese and the Americans seems to be going back to where it was last time Trump was in power, and they started taking a stance on the rare earths. As an analyst, a fund manager, do you look at these smaller segments of the market like rare earths, or maybe even cobalt? These in comparison to copper are so small.
That's the problem with them. Yeah, as if you're a speculator, if you're more a PA, a private investor, say you want to put $5,000 or $10,000 into an investment, you can ride these little metals, your antimonies and your cobalts and all those sort of things, and you can have these, molybdenum. You can basically have these amazing short-term lifts. But I think long-term as investing, there is reasons why certain nations of the world dominate these certain commodities. Niobium's another one, and it's just that there's usually one or two big deposits that essentially supply most of the world, and they're generally not owned by a junior. And often when there's some sort of warm theme, like you kind of seen it in antimony at the moment. There's dozens of juniors popping up in Vancouver and around the world saying, "Oh, we've got a gold antimony play," kind of story. Now, yes, you can, if you get in early enough and cheap enough, you can ride them up, but you've got to jump off. It's never view them as an investment, view them just as a short-term trade. It's essentially a greater fool theory trade. You're relying on somebody buying that stock at a higher price than you. Just don't forget about it, because in 2 years' time, it'll all be over. These small commodities generally have short-term price spikes. They can be pretty violent, pretty volatile, but they do generally tumble again when the world, when trading resumes, let's say. And, and China's cut some of these metals off, and that's what we're reading in the media. You kind of wonder what's really going on in the background. I'm sure the Americans are really talking to the Chinese at some level. yeah, it's in their it's in their self-interest to communicate to some level, and I'm sure they've not completely cut off all trade and all communication.
In closing, are there any companies that investors should be taking a look at right now?
Well, you mentioned prospect generators before, so maybe I'll mention one of those. And plus, before I said, and this stuff's all public, so I'm not saying anything I shouldn't be saying. You know, I work part-time with Centerra Gold, and I kind of manage a little bit of money, which they've asked me to invest into precious metal equity stories, essentially in North America. So I've done 3 investments this year, bought 9.9% of 3 juniors, and maybe I'll just mention those juniors and why in a couple of sentences. The first one was Kenoland Minerals, ticker's KLD. Kenoland is focused on early stage gold exploration, essentially in Quebec and Ontario, and a little bit into Manitoba. It's a very, very unusual junior because market cap's maybe $80 to $90 million. They've got $30 million in the bank. They've got a collection of royalties that are probably worth the remainder of their market cap. Excellent group of people doing true grassroots exploration, which I don't think you really see that happening that much anymore. And I had a call with them a few days ago, and they've taken 20,000 geochemical samples, essentially in underexplored areas of Ontario and Quebec and Manitoba this summer in 6 weeks. Now, everybody looks super tired. You know, the guys are out there working really, really hard, and I give them a round of applause because as an exploration geologist, I just never see that level of true grassroots exploration anymore. So that's one junior I mentioned that Centerra has bought 9.9% off through an investment, put $6 million in the company. It's turned out pretty well so far. From the point of view, and again, my aim there is not to make money out of the stock. It's really to assist the junior in making a new gold discovery in Canada. Now, the second junior I'll mention, which is also precious metals, similar prospect generator model, is Headwater. They're focused in Nevada. They also have a couple of assets in Idaho, and they were in Eastern Oregon. So good group of young geologists, you know, again, super focused in finding a low sulfidation epithermal precious metal deposit in Nevada. It's probably going to be undercover. You're not finding much sticking out of the ground in Nevada anymore. But again, technically very savvy, like the guys, very honest, very ethical. So I'm quite happy backing those guys to pick up some new projects in the next 12 months or so. And then the third junior, just about closing the financing now, it is public, is a junior focused on a piece of ground in northwest Ontario called Dryden Gold. Got some high-grade old gold mines that were mined years ago. They've drilled a few holes around them, essentially just sort of confirmation drilling, really. But the investment Centerra just gave them, plus a prior raising, has now given them essentially $8 million. And for the first time next year, they've got a nice treasury to go and do some, you know, a good exploration program on the ground. I like the 2 geologists running the exploration program, Maura and Anna. You know, a lot of Red Lake experience, a lot of that high grade Northwest Ontario greenstone experience, and you know, it's basically a risk punt. But I think it's quite a good opportunity. I'm looking forward to seeing them drilling some holes and hopefully having some success in the fields in the summer of 2025.
Excellent. Neil, it's been an absolute pleasure having you on the show. We definitely have to do this again soon.
All right. Thank you very much, Brian. Appreciate it.